If you've ever looked at a company's financial statement and wondered how they actually decide when and exactly how to count their cash, well, you are in the right place. Welcome to this explainer. Today, we're diving into the exact mechanics of how companies report their income, and we're going to do it without getting bogged down in impenetrable jargon.
Okay, let's kick things off with a really fundamental question. Does getting paid cash, like actual money sitting in your bank account, mean you can officially recognize revenue? The short answer is absolutely not. It's incredibly common to have cash in the bank that you cannot legally call revenue on your books just yet. And, conversely, you might recognize revenue before you've seen a single dime of cash.
Now, this wall of actual regulatory text looks incredibly intimidating, right? This is paragraph 1 of IFRS 15, which is basically the global rulebook for revenue recognition. It totally looks like a massive headache of legal compliance. But don't worry, we are going to translate this into a really simple, logical playbook you can apply to almost any business transaction.
Here is that playbook. First, the core revenue principle. Second, identifying contracts and promises. Third, determining the transaction price. Fourth, recognizing the revenue. And finally, special rules and exceptions.
Let's jump right into step 1, the core revenue principle, which is the absolute foundation of IFRS 15. So the crucial takeaway here is that revenue recognition is about accurately depicting the transfer of goods or services for the exact consideration you expect to receive. It isn't just about when an invoice goes out in the mail. It's really about matching your performance, what you actually promised to do, with the economic benefit you expect to get in return. It's supposed to tell the true story of your business's performance.
Moving right along to step 2, identifying contracts and promises, and more specifically, finding those distinct promises. Now, a contract doesn't just have to be a 50-page document signed with a wax seal. It turns out it can be entirely oral or even just implied by your customary business practices. If your industry operates on handshakes and historically honors them, IFRS 15 actually recognizes that as a valid contract, just as long as it creates enforceable rights and obligations for everyone involved. To make it official, there's a highly digestible 5-point checklist. For a contract to officially exist for accounting purposes, it absolutely must meet all 5 of these criteria. You need approval from both sides, identifiable rights, clear payment terms, and actual commercial substance, which just means the risk or timing of your cash flows is going to change. And crucially, it must be probable that you'll actually collect the money. Because if you know upfront the customer can't pay, well, you don't have a valid contract for revenue recognition. Once you've got that contract, you have to figure out what you actually promised to do. Whenever you hear accountants use the heavy jargon performance obligation, just translate that in your head to a distinct promise that the customer can benefit from. For example, if you sell a software license and mandatory installation, are those 2 promises or just 1? If the customer can benefit from them separately, they are distinct. All right, step 3, determining the transaction price, or simply put, pricing the deal. The transaction price is essentially what you realistically expect to take home. But here is a massive rule you got to remember. This price completely excludes any amounts you might collect on behalf of third parties, things like sales taxes or value-added tax. Why? Because that isn't your money to keep. It's literally just passing through your hands on its way to the tax collector. But hold on, what happens when the price isn't a fixed number, like if you have discounts, rebates, or performance bonuses built into the deal? In that case, you must estimate this variable consideration using one of 2 methods. You can use the expected value, which is a probability-weighted average, great for when you have a ton of similar contracts, or if it's an all-or-nothing type of bonus, you use the most likely amount. You kind of have to predict the future, but only to the extent that it's highly probable you won't have to awkwardly reverse that revenue later on. And what about time? If your timeline stretches out and gives the customer a significant financing benefit, like, say, giving them 2 whole years to pay after delivery, you must adjust the price for the time value of money. Because at that point, you're essentially acting as a bank providing a loan. However, there's a really handy practical expedient here. If the gap between transfer and payment is 1 year or less, you can skip this complex interest calculation entirely.
Which brings us to step 4, recognizing the revenue. Knowing exactly when to push the button.
Under the old rules, revenue was all about transferring risks and rewards. But IFRS 15 completely flipped the script. Revenue is now only recognized when the customer obtains control. Think of control as having the keys to a car. It means you, and you alone, can direct its use and reap its benefits. You can sell it, you can pledge it for a loan, or just hold on to it.
When the customer gets those keys, that is when you have revenue.
But when exactly do they get those keys? We have to heavily differentiate between promises satisfied over time versus those satisfied instantly at a point in time. If you run a daily office cleaning service, the customer consumes the benefits simultaneously as you do the work. That's over time. But handing someone a cup of coffee over the counter, that happens instantly, at a single point in time.
If you are recognizing revenue at a point in time, like selling that cup of coffee or maybe a massive piece of heavy machinery, you need to look for specific indicators to prove that control has officially left your hands. Do you have a present right to payment? Has the legal title transferred? Do they have physical possession of the thing? Have they formally accepted it? These are your green lights to go ahead and record the revenue.
Alternatively, if it takes time to satisfy the promise, you can't just guess how much work you've done. You actually have to measure your progress. You can use direct output methods, like surveying the specific milestones you've reached or units delivered. Or you can use internal input methods, like carefully tracking your labor hours or the costs you've incurred relative to the total expected costs.
Finally, step 5, special rules and exceptions. This is for all those messy real-world cases.
Let's take sales with the right of return. You simply cannot recognize revenue for goods you think are going to come right back to you. You only recognize revenue for the items you actually expect to keep the cash for. For the rest, you have to book a liability for the expected refund and a corresponding asset representing your right to physically get those products back.
Warranties require some really careful thought too. Is the warranty just a basic guarantee that the product isn't defective out of the box? That's an assurance-type warranty. You just book a provision for the expected repair costs. But if a warranty provides a real service beyond basic compliance, like a completely separate extended maintenance plan, that gets carved out as its own distinct performance obligation, and you have to allocate a portion of the transaction price directly to it.
You also have to figure out if you are the principal or merely an agent. If you control the good or service before it goes to the customer, you are the principal, meaning you record the gross, total amount the customer pays as revenue. But if your job is just to arrange the deal, kind of like a travel site booking a hotel room, you are just an agent. You only get to recognize your specific fee or commission as revenue.
One last quick note on costs. IFRS 15 actually allows you to capitalize the incremental costs of obtaining a contract. This is a real game changer. It means you don't have to expense a salesperson's hefty commission all on day one. You can capitalize it directly as an asset on your balance sheet if you expect to recover it over time. You can do the same for direct costs to fulfill the contract, provided they generate resources used to satisfy future promises.
So to wrap up this explainer, I want you to try something. Look at the receipts from your own daily purchases or your business subscriptions. Look at your streaming bill or your gym membership and ask yourself, how many distinct promises did you actually buy? And when exactly does that company get to call your cash their revenue? Once you start seeing the world through the lens of IFRS 15, I promise you, you'll never look at a transaction the same way again. Thanks for joining me on this explainer.